So you wanted to start investing, but you don't know how and which company to pick. I got you. What you're looking at is a list that we're going to use to get a quick image of the company's fundamentals before you start investing. So let's start. First is revenue, also known as the top line. We'll use this to know how much money did the company earn selling its services and products. Let's start with Apple, Johnson & Johnson, Starbucks, and Sanderson Farms. For Apple and Johnson & Johnson, looking at this graph, over the past 10 years, they've been consistently growing their revenue, with Apple growing their revenue by 33% last 2021. Same thing with Starbucks and Sanderson Farms. They've been consistently increasing their revenue over the past 10 years. So, for our new kababayan investors, a good starting point when you're looking at the company fundamentals is a growing revenue. After looking at the revenue, we need to know how much money did the company keep after paying the cost of productions like raw materials and wages, but before paying interest and taxes. This is where we look at each company's operating margin. A larger operating margin means that the company keeps more of every dollar from its sales as profit. So the larger the better. If you look at Apple's operating margin last 2021, they kept 29% of their sales as profit. For Johnson & Johnson, their operating margin on the same year is 26%. For Starbucks, they definitely increased their operating margin from 6% last 2020 up to 16% last 2021. Same thing with Sanderson Farms. Their operating margin last 2020 is 0%, and it jumped up to 13% last 2021. When we look at operating margin, we only use this to compare different companies from the same sector. Right now, we have 4 different companies from 4 different sectors. That is technology, healthcare, consumer staples, and consumer cyclical. If we're just meeting today, hi, my name is Ron and welcome to Pinoy Stock Investor, where we help our kababayan start their investing journey. Okay, let's shift gears and start talking about the return on invested capital, or ROIC. When a company consistently shows a high ROIC, it is usually considered as a good investment, and the stock usually trades higher. It also shows an overview how well the management is using the company's capital. Looking at Apple's ROIC, last 2021, it's about 51%, meaning that for every dollar invested in Apple, the company is generating 51 cents. For Johnson & Johnson, it's 20%, for Starbucks, it's 25%, and for Sanderson Farms, it's 27%. If you look at the historical ROIC data for the past 5 years, Apple, Johnson & Johnson, and Sanderson Farms are actually doing well, while Starbucks is currently bouncing back up. After looking at their performance, let's look at how much cash did each of these companies kept after paying the bills. We call this free cash flow, and an increasing free cash flow is an early sign of an increased earnings. Let's look at Sanderson Farms. Their free cash flow last 2021 is $458 million. And if we look at the historical data, they definitely beat the past 4 years. Last 2018, Sanderson Farms actually had a negative free cash flow. Their revenue went down and they were not able to generate excess cash. But from the looks of it, they are currently doing well, especially because of their revenue last 2021. Remember that historical data doesn't guarantee future results. Please do your own research and consult your own financial advisor before investing your money. Now let's look at Starbucks. Their free cash flow is a bit close to negative last 2020 because of the lockdown. But if we look at the 2021, they have a big comeback with $4.5 billion of free cash flow. For Johnson & Johnson, a really strong and growing $19.7 billion free cash flow last 2021. And for Apple, a whopping $92.9 billion annual free cash flow, a 26.7% increase from 2020, which is also a record $73.3 billion. Full disclosure, I'm invested in Apple and it's one of my top holdings. I did make a video showing all the companies in my portfolio. You can see the link down below. And let me know if you're getting value to this video. The best way to do it is by subscribing and liking this video. And it will really show that what we're doing here provides a value to you, kababayan. Going back to our list, when we're looking for a company to invest in, we should also check if they're returning value to shareholders, which is us, in the form of share buyback and dividends. On Apple's latest earnings call, they announced an increase of $90 billion of share buyback, which reduces the number of outstanding shares. What it means is the EPS, or earnings per share, can grow more quickly as the revenue and cash flow increase, essentially increasing the value of the stock. If we look at Apple's shares outstanding, we can see that they are consistently buying back their shares, the same as Johnson & Johnson and Starbucks. For Sanderson Farm, it looks like it's been a while since they did a buyback. Now let's look at each company's dividends. For Johnson & Johnson, they have a forward dividend yield of 2.46% with a forward annual payout of $4.52. Payout ratio is about 42.91%, and for 59 years, Johnson & Johnson has been growing their dividends with a 5-year growth rate of 5.79%. For us dividend investors, a payout ratio of under 50% is definitely a great value. For Sanderson Farms, they have a forward dividend yield of 0.92% with a forward annual payout of $1.76. Payout ratio is 6.15%, showing that they have a lot of room for an increase if they consistently grow their free cash flow and revenue. There will be a high chance of a dividend increase. They have been growing their dividends for 2 years with a 5-year dividend growth rate of 13.85%. For Starbucks, a forward dividend yield of 2.56% with a forward annual payout of $1.96. Payout ratio is 56.12%, which is kind of high. They have been growing their dividends consistently for 11 years with a 5-year dividend growth rate of 15.87%. For Apple, which just announced a dividend increase, the forward yield is 0.54%. They have an annual payout of 0.96 cents per share with a payout ratio of 14.57%. They have been growing their dividends consistently for 9 years with a 5-year growth rate of 9.07%. The value might be updated, but these are values as of my recording. Going back to our list, when you're trying to pick a high quality dividend companies, 1. Look for their revenue. Are they trying to consistently grow their top line? You also need to look at their operating margin. The larger the margin, the more profit the company keeps. ROIC shows how well the company management uses their raised capital to generate returns. A consistently increasing free cash flow shows that the company has a great momentum and the stock has a high chance to sustain its bullish trend. Share buyback and dividends are ways companies provide return to the shareholders. Additionally, consistently increasing dividends shows that the company has a stable cash flow. So what can you do with this info? If you learn the fundamentals of the company, you will understand how the business is performing. If you understand how the business is performing, you will be able to gauge if your investment is profitable or not. Like what Jeff Bezos said,
the stock is not the company, and the company is not the stock. And so as I watched the stock fall from 113 to 6, I was also watching all of our internal business metrics, number of customers, profit per unit, everything you can imagine, defects, etc. Every single thing about the business was getting better and fast. And so as the stock price was going the wrong way, everything inside the company was going the right way.
If you get value in this video, hit the like button. Subscribe to my channel to get updates on my future videos. It's free and it will definitely help my channel. Let me know what you think down below in the comments. And if you're planning to sell your stocks, I made a video on how and when to sell your dividend stocks.